It started quietly at U.S. Bancorp, where Paula Cummings, head of currency sales, noticed a subtle but significant change. More American companies were asking to settle international bills in Chinese yuan instead of dollars, a request that had once been rare, but was now becoming increasingly common. This wasn't just a niche trend among a few adventurous firms. Mainstream businesses, large and small, were being nudged by their Asian suppliers to bypass the dollar entirely and settle deals in yuan. The pressure was subtle but persistent, and it was coming from some of the world's fastest-growing markets. U.S. Bancorp's decision to facilitate yuan transactions is a pragmatic response to client demand, not rebellion. The bank isn't making a political statement. It's simply adapting to the realities of global commerce, where flexibility is now a competitive advantage. For decades, the dollar's dominance made global trade simple and predictable. But now, the world is building alternative pathways, experimenting with new ways to move money across borders, and challenging old assumptions about how business gets done. The bank's move is a microcosm of a much larger global shift. The dollar's so-called exorbitant privilege, its unique status as the world's reserve currency, is being questioned, and for the first time in generations, that privilege is facing real competition. These early tremors could have major consequences for the U.S. economy, from interest rates to government borrowing. If the world needs fewer dollars, the cost of borrowing could rise, and the government's financial flexibility could shrink. The de-dollarization trend is no longer theoretical, it's happening in the heartland, reaching beyond Wall Street and Washington into small towns and rural communities, where businesses are quietly adapting to a new reality. U.S. Bancorp is simply following the money, which is starting to speak in new currencies. The bank's clients want options, and the financial world is responding with new tools and services. The implications are vast, touching every American household. From the price of groceries to the value of savings, these shifts in global finance will ripple through daily life in ways both visible and invisible. A quiet shift in Minneapolis could echo across the nation for decades, shaping the future of American finance and the role of the dollar in the world. For more than 70 years, the US dollar has been the world's default currency. Central banks across continents hold vast reserves of dollars. Global commodities like oil and gold are priced in it, and international trade flows depend on the greenback's stability. From the bustling ports of Asia to the trading floors of Europe, the dollar is the invisible thread tying the global economy together. This dominance gives America unique advantages. It can borrow cheaply, finance deficits with ease, and wield enormous influence over the world's financial system. The dollar's status as the world's reserve currency is a pillar of U.S. power. But the landscape is changing. The Chinese yuan, once used almost exclusively within China's borders, is now being internationalized as China's economic might expands. Beijing is determined to make the yuan a true global contender. The dollar is open and market-driven, shaped by the forces of global supply and demand. In contrast, the yuan remains tightly managed by Beijing, with strict controls on its movement and value. Yet China is gradually loosening its grip. Through swap lines, offshore trading hubs, and new financial agreements, the yuan is becoming more accessible to international investors and businesses. Despite these efforts, the dollar still dominates global finance. An astonishing 88% of all foreign exchange trades involve the dollar, while the yuan accounts for just 7%. The gap is still wide, but the momentum is shifting. Over the past 2 decades, the dollar's share of global reserves has slipped from over 70% to under 60%. This decline signals a slow but steady erosion of its once unchallenged supremacy. Meanwhile, the yuan's share, though still small, is quietly rising. More countries are adding it to their reserves, and more trade deals are being settled in yuan. The story isn't about the yuan replacing the dollar overnight. Instead, it's about the emergence of a multipolar currency world, where several currencies share influence and power. The dollar must now share the stage with new rivals, adapting to a world where its dominance is no longer absolute. What matters most is not just where we are today, but the direction of change. The global financial system is evolving, and the pace of that evolution is accelerating. The world is moving away from a single currency system toward one with real alternatives, ushering in a new era of global finance, where power is more widely distributed and the future is more uncertain than ever. American companies aren't abandoning the dollar out of disloyalty but to manage risk. Currency fluctuations mean Chinese suppliers want to be paid in yuan, shifting exchange rate risk to U.S. buyers. The US has used the dollar as a foreign policy tool, imposing sanctions that make other countries wary of relying on it. China encourages Yuan use through initiatives like Belt and Road and its own payment systems. For many businesses worldwide, transacting in Yuan is becoming easier and more attractive. Political instability in the US is another factor. 70% of global central banks cite it as a reason to diversify. Unpredictable US policy makes the dollar seem riskier. Companies are seeking stability and predictability elsewhere. The dollar's reserve status has let the US borrow cheaply for decades, fueling massive deficits. This unique position has allowed the government to finance spending at lower interest rates than most other countries, making it easier to run up debt without immediate consequences. For years, the world's trust in the dollar has acted as a safety net, keeping borrowing costs manageable even as the national debt soared. But as global trade shifts to other currencies, demand for US Treasury bonds drops. Countries and companies are starting to settle more deals in euros, yuan, and other alternatives, reducing their need to hold dollars and US debt. Foreign ownership of US debt has fallen from over 50% to 30% since the financial crisis. This means fewer international buyers are willing to finance America's borrowing, putting more pressure on domestic investors and the government itself. Less demand means the US must offer higher interest rates to attract buyers. The government can't simply assume the world will always line up to lend it money at bargain rates. Even a small rise in rates adds up. Bloomberg estimates this could cost the US an extra $1 trillion in debt payments over the next decade. That's money that could have gone to schools, infrastructure, or healthcare, now redirected to pay interest. Higher government borrowing costs trickle down. Mortgages, car loans, and business loans all get more expensive. When the government pays more to borrow, so does everyone else, making it harder for families and businesses to afford big purchases or invest in growth. The dollar's privilege has been a hidden subsidy for American life, quietly lowering costs and boosting prosperity for decades. As it erodes, the real cost of borrowing becomes clear. Households may find it harder to get loans, and monthly payments could rise, squeezing budgets across the country. This isn't just a government problem, it affects every American household. From the price of a new home to the cost of starting a business, the impact will be felt in daily life. The era of easy money is ending, and the transition could be bumpy for families, businesses, and the broader economy. The consequences will be felt across the economy, reshaping how Americans borrow, spend, and plan for the future. Central banks, once content to hold mostly dollars, are now diversifying their reserves. A 2025 survey showed the dollar had dropped to 7th place in future investment attractiveness. Sanctions and US political instability are driving this shift. Central banks are moving funds into euros, yuan, and other assets to reduce risk. The euro is the top short-term alternative. 16% of central banks plan to increase euro holdings soon. The yuan is the long-term bet. 30% plan to boost yuan reserves over the next decade. The BRICS nations are promoting their own currencies for trade. This is more than finance, it's a geopolitical realignment. The dollar's infrastructure is vast, but alternatives are rising fast. Central banks' collective actions are reshaping the global economy. As the dollar's dominance fades, central banks and investors are turning to a range of alternatives. Gold is back in favor. 40% of central banks plan to increase gold reserves, and prices could hit record highs. The euro, backed by a large, stable bloc, is gaining ground as a reserve currency. The European Central Bank's steady policies make the euro attractive compared to US unpredictability. The yuan's potential is huge, especially as China dominates global trade. Oil sales are increasingly priced in non-dollar currencies, even by US allies like Saudi Arabia. Regional currencies like the peso and Canadian dollar are also gaining traction. Local currency debt markets in Latin America now outsize international ones. The world is building a network of financial roads, not just a single highway. A multipolar currency world is emerging, more complex but more resilient. These global shifts will hit home for American families. As demand for US debt falls, borrowing costs rise. Mortgages and loans get pricier, making homeownership harder. Imported goods will cost more, fueling inflation and squeezing budgets. But a weaker dollar could boost US exports, helping manufacturers and farmers. The US will face tougher choices on government spending as cheap borrowing ends. Financial sanctions will lose power if countries can avoid the dollar. America must adapt, competing in a world with real currency rivals. This isn't doom, but a call for change. Focus on innovation, domestic strength, and prudent finances. The shift from a unipolar to multipolar currency world is underway. For Americans, it means higher borrowing costs, pricier imports, but new opportunities for U.S. industry. The quiet changes at U.S. Bancorp are a wake-up call. The world is moving on, and so must America.